So let's jump straight into it. Okay, there we are. Alrighty, so as we go along, guys, I'm sure lots of questions are going to pop up as they do with all of this stuff. We're going to go through quite a lot. So what I'd encourage you to do is if any questions do pop up, feel free to take a bit of a note. There may be a chance that some of the other slides or other content we're going to go through may cover off that question already. However, we will have some time for questions at the end. So if for any reason it's not covered off and you'd like to ask it, please feel free to let us know and we'd be more than happy to have a look at it. So let's jump right in. So I wanted to first off talk a little bit about the buzz that we've seen around a lot of the news that's been happening regarding the interest rate, these changes. What does it all mean and how's that going to affect you in terms of buying your first home? So if we have a look at the slide, what we can see is what a rate change does to your borrowing capacity. So over on the left-hand side, we've got a sample household income. We've got from 150 to 225. So if we look at the $150,000 household, prior to the most recent rate cut that we had back in August, you're looking at a peak borrowing capacity of about 803,000. Now that we've had another rate cut, we're looking at about 822,000. So if you look at that, we're talking almost $20,000 in terms of borrowing capacity just from a rate cut alone. As we can see, following on to the next cut, if there is another cut before the end of the year, we're looking to get some further increase into our borrowing power as well. So that'll apply for everybody, but as we can see, the effect it will be magnified depending on what the household income is. So I think just to talk a little bit about what the interest rate's doing, where it's going to be at, I don't really like to talk about what my opinions are, but let's talk about what the big banks are saying. So we've got two of the big four banks do still think there's going to be another rate reduction between now and the end of the year. So hopefully we see that. Hopefully we see a bit of an increase in borrowing power. We've got the other two big four that are forecasting a rate cut very early next year. So although it doesn't guarantee, it does give a good insight that the leaders in the market, the big guys that generally have all the information, they've got some good feelings about how it's going. So it's a very promising time to be looking to buy your first home. The next thing I thought we could just start off with is some home loan basics, just some really nice and easy things. As I'm sure you guys are learning as you're looking at buying your first home and maybe looking into the lending side of things, there's a whole lot to think about. And unfortunately, I don't think an hour will quite cut it to go through all the ins and outs, but just to give you a little bit of an overview of some of the different things we're going to be talking about, some of the things that come up, I've just got a couple of dot points. So if we start off with, we've got standard variable loans. You might have heard this term. It's very, very jarring. What does it all mean? It really just means we've got a variable interest rate. So when we have an interest rate, which is basically what the cost of your loan is going to be, how much you're going to have to pay back, we've got variable loans and we've got fixed loan. So a variable interest rate is going to go up or down over the term of the loan. And that means as the interest rate goes up, so do your repayments, so does the cost of your loan. However, if the rate is to come down and you're on that variable loan, you're going to get all those benefits of the rate reduction. You're going to save yourself some money. So one interesting point I might note, because we can see that we've also got a fixed interest home loan there on the third point. Fixing, we can generally fix the loan for about 1 to 5 years at a time. At the end of the fixed period, we've got to have a bit of a review and fix it back in again. Everyone always wants to know, they say, Mitch, should I go for the variable loan or should I go for the fixed loan? What's going to be the cheapest option? And I think that when we look at these kind of loans from that perspective, we tend to not do ourselves any favors. So I would encourage you guys, if you're thinking about these things, fixed variable, what's that going to look like? What you need to do is think about it from a perspective of consistency. So a fixed rate or a fixed interest home loan is going to have the exact same repayment. Whether or not you're paying weekly, fortnightly, monthly, it's the exact same. So if you've got a reason that would warrant knowing to need to know exactly what that repayment is for budgeting purposes, pardon me, or anything else like that, a fixed loan can be a really good option. But the most important difference between these two products is the variable loans are a lot more flexible. We can make lots of extra repayments. We can refinance anytime. There's less restrictions. Often, if we have a fixed loan, the lender's going to make us pay a fee if we're going to either make too many extra repayments or we want to pay off that loan sooner. So important to keep in mind. The next thing we want to talk about is construction loans, because of course, in the world of land and construction, we tend to see a lot of these. So in terms of having a construction loan, you don't actually need to pay off the full loan until construction's complete and you're living in the house. So what does that mean? What it means is if you've got a construction loan and let's say it's $500,000, you'll only pay interest on what you owe. So at land settlement, the bank's going to pay the land developer some of the money from your mortgage and you'll have a loan balance. That might only be 200, 250,000, for example, out of your whole loan. All right. All you need to do is cover the interest that accrues on that amount during the construction phase. So as you can imagine, as the builder is doing more work on your home, the bank's making more payments to the builder, the size of your loan's getting bigger and bigger. So's the interest you're going to get charged. My advice to a lot of my clients is if in the early stages of your construction loan, when you're not getting charged as much interest, you've got some capacity to make a bit of extra saving, pad your pockets out a little bit, it's going to make the end of construction a lot easier, particularly if we're looking at our first home, there's a chance we might be renting. So trying to balance our rental costs and our interest repayments can sometimes be a little bit tricky. And that's why it's always a good idea to have that foresight, get yourself ready to go. The last thing to talk about is just an offset account. I'm sure everyone's heard this word, but not a lot of people know what it means. So an offset account's pretty simple, actually. I'm sure most people have had a savings account or any bank account with any financial institution where you've been paid interest. So typically, if you put some money in a bank savings account, they're going to pay you interest on that money as payment for keeping the money in that account. Likewise, an offset account works in a similar way. However, instead of earning interest on the money you keep, you offset the interest you get charged on your home loan. So for example, if we look down the bottom, we can see an example. If you have a $400,000 loan balance that you owe to the bank, but you've got $20,000 in your offset, at the end of the month, the bank will only charge you interest on 380. They'll take that into consideration. So in actuality, it's not really going to make our repayments cheaper. We're still going to have the same repayment. But if we're getting charged less interest, we're going to pay off our home loan quicker. We're going to save ourselves some money on interest. All right. So that's really just some of the home loan basics, some of that terminology. As I said, it doesn't cover all of it, but that's why we're here. That's what we're here to help with. So we might just move on into how we can look to improve your borrowing power. So when we go to buy our first home, often we don't really know how much we can borrow. There's obviously a lot of lender borrowing calculators out there on the internet. We can put a bit of our borrowing, a bit of our income in there, how much we're spending, etc. And it's going to spit out a figure and let us know what they think we can borrow. But it's important to know there's a lot of other things that come into consideration other than your income that can impact the timeline to purchasing your first home. So here's a couple of points that we can look at. So tidy your accounts. So avoiding any overdraws, late fee payments, any red flags that are going to raise with the lender and make them question things a little bit more. So we want to show nice, clean spending conduct, make sure that we're keeping things nice and tidy. The next thing we have is to get rid of any of our unused credit limits or buy now, pay later. So that's things like Afterpay, Zip Pay, any credit cards or things that we had that we're not using. Could be a really good idea to close them down up front. It's always going to improve the borrowing power. However, often when we have a credit card or these kind of things, we might still have a debt to pay off. We also might be using it for points, these other things. We might have a desire to keep that open. There may be a possibility to do that. And that's why it's always a good idea to have that chat with a broker, work out what your borrowing capacity is with those existing credit limits, etc. And we can help you to let you know if you need to close them, when you need to close them, and we can help to come up with a plan about doing that. Following on, we've got clear short-term debts. So this is something obviously very similar, but more so, even if we've got car loans, personal loans, or these other things, making some extra repayments, albeit we've already got our savings together. If we've also got capacity to pay down those loans, reduce those limits a little bit, that can also be very helpful for improving borrowing power. Okay. And this next one's a big one. So we talked on savings there a little bit. You can see here it says genuine savings. So what the bank considers genuine savings is when we show a bank account statement for 3 months and we show over that 3 months, we're making consistent deposits into that account. We're saving regularly from our salary, and that's how we've got to the point of building up our savings. I want to be very clear that you don't need to show you've got all your savings together in 3 months, but we do need to show that over 3 months, we've got a consistent history. It's not the case that on the last day of the third month, we had all of this money dumped into our account. They won't consider that as genuine savings. Okay. The next one is in terms of documenting your income well. So when we say documenting, we're not talking about writing down our income or anything like that. We're really just talking about fulfilling your obligations to your employer. So, for example, if you're working part-time, you're working full-time, if you're getting sick leave or annual leave every now and then in those pay slips, that's absolutely fine. There's no issues there. But try and avoid things like unpaid sick leave, these other things. Of course, there's always times where this is unavoidable. We can look to mitigate it if it comes up. But if we're talking best case scenario, always best to make sure that we're working the hours that we have to in line with our employment agreement. And then in terms of, we've got trimming living expenses. So if we've got anything in terms of subscriptions we're not using, anything else that we've got direct debit set up for that we don't have, it'd be a really great idea to get rid of those things up front and to make sure that we can stick to a budget that not is something that's sustainable, not something that we can only do for a month and we have to go back to our other spending. Try and come up with a budget and look at your living expenses and see what we can do to come up with a sustainable game plan going forward. And what that means is we want those expenses to be in line with what you can sustainably spend each month, not only when you're applying for the loan, but also after you've got the mortgage for the next 30 years. It's very important to make sure that we've got our expenses in line to show we can make our repayments over the loan term. And then the last note I've just made is avoiding any new liabilities prior to approval. So that means not taking out a car loan, new credit card, or Afterpay, Zip Pay, either during the application process or beforehand, because these things can sometimes have an impact. If it is the situation, though, where let's say we need to take out a loan for a new car and that's unavoidable or these other things, maybe before you do that, if you do get the chance to chat with a broker ahead of time and say, look, I want to build this house. This is how much I'm looking to spend. I also am looking at taking out this car loan. Is it possible to do both? So much better to get that information up front before you've made the decision so you know ahead of time instead of going and making the decision and then learning out that it's become a problem. It's all just to make sure you've got a nice, smooth experience all the way through. So I think that really covers it off just in terms of the basics, borrowing power, etc. So I wanted to spend quite a bit of time tonight looking at our first home buyer incentives because I can imagine as a first home buyer today, with everything on the news, with everything in social media, it is so hard to navigate. What is applicable to us? What incentives can we claim? What can't we claim? How many of them are there? How do we navigate all of this? So I want to make sure that we take this slow, we do it nice and clearly, and we make sure that you're fully aware of what incentives are out there and how you can actually access them as well. All right, so I'm just going to have a bit of water, get myself ready to go. So this is the big one, 5% deposit scheme. So I'm sure most people have heard about this either in the news, on Facebook, anywhere else. It's the talk of the town at the moment. So one important thing to clarify is this isn't actually a new scheme. It's an expansion of something that was already in place. So the first home guarantee scheme's been around for a few years now. It allows you to put in a smaller deposit, but the lender treats you like you put in a larger one, more or less. We'll clarify a little bit of that later on in the piece. So what's changed? So on the 1st of October, the government's basically expanded the eligibility for this 5% deposit scheme, and so many more people fit within it. Basically, everyone who's a first home buyer. So previously, we had pretty strict caps on the amount of income you could be earning and also the property price cap that you could be purchasing. It was quite below what the median price of a property was in Victoria. And for that reason, across the board, what the government's done is they've looked at the thresholds in each state and they've lifted them up. The great thing as well is they've taken that income requirement and they've thrown it out the window. No income cap at all, doesn't matter how much you're earning, which is a really great thing. Because one thing we notice from a broking perspective is a lot of people who are working and earning enough to be able to save to buy their first home, they're earning too much for the scheme. We couldn't put them on there. And that put them a lot further away from buying their first house than they otherwise would be if they could have accessed this scheme. So let's just have a read. So under the new home guarantee scheme, the government will guarantee up to 15% of the home loan, allowing first home buyers to enter the market with just a 5% deposit and crucially without paying lenders mortgage insurance. So let's clarify this. I'm sure most people have heard the term 20% deposit before, all right? And that's when we think like a buyer. Let's think like the bank for a little bit. What the bank is saying is, we don't want to lend you more than 80% of what your property is worth because that's too risky for us. So we want you to put in 20% and cover the fees so that it's not as risky. And if you do that, we'll give you a good interest rate and we won't make you pay lenders mortgage insurance. So usually, if you want to put in 20%, less than 20% plus the fees, and you want to borrow more than 80%, the lender's going to stick you with an extra fee and they give you a much higher interest rate. So already we've got higher upfront costs, which means we need more savings. And secondly, with that higher interest rate, our borrowing capacity comes down. So it can have an impact, and it might be the difference in preventing us from borrowing the amount we need to get into that house. So that's why you can put in between 5 and 20%. The government will, pardon me, the bank will treat you like you put in 20% because the government's guaranteeing it. I want to make a very, very important note regarding this. Although it says the government will guarantee up to 15% of the home loan, they are not taking any ownership stake in the property. The government does not have any ownership over your home. There is another federal government program that will potentially be implemented next year that may involve something such as that. It will be similar to the Victorian Home Buyer Fund, if anyone's heard of that. We're not going to get too much into that because, as I've mentioned, it doesn't actually exist yet, and we don't know what the ground rules are. But it's important to know that under this scheme we're talking about, the guarantee scheme, that is not applicable. I've noticed that a few people are getting confused between these schemes, so there is no ownership under this arrangement. Okay, so as I've mentioned, no income caps, everyone qualifies. We've got the price limits been raised. It's now 950,000. The only important thing to keep in mind is that 950 applies to more metropolitan inner Melbourne regions. If you're looking at something more regional, more rural, that has a lower cap of about 650. There is a postcode tool on the First Home Guarantee Scheme website, and you can search up the postcode you're looking to buy in. It'll let you know whether or not you're on the higher threshold or the lower threshold. If you're not sure how to do that, come and speak to us or one of our brokers. We're more than happy to help you to work that out so you don't have to navigate that on your own. Okay, so first government incentive, first home buyer scheme, first home guarantee scheme. So reduced deposit, no mortgage insurance, better interest rate. It's a federal scheme for the whole of Australia. The next one we're going to talk about is our first home buyer incentives on a state level. Okay, so not the federal, but the state. So in each state, we have a first home owner's grant. It's nice and confusing because it looks a lot like the first home guarantee scheme. So the difference is the first home owner's grant is only available for new builds and it differs from state to state. So as we can see here, we've got $10,000 for eligible buyers of a new home up to 750,000. You must live in it as your principal place of residence. Okay. So let's put a very important bit of clarification because we're looking at land and construction. So if you were to go out and buy a property that had already been built for you, it has to be 750 or less. Otherwise, you're not going to get that 10,000. Even if you're under the 950K cap for the guarantee scheme, you're over for this one. The great thing about land and construction is in Victoria, this $10,000 payment and the 750 cap only applies to the construction contract. So for example, if you're doing 500,000 on land and you're doing 450 on build, you're on that 950K cap for the guarantee scheme. Because your build's only 450, you're still under that cap. You still get the $10,000. And the great thing is, it's not the case of if you use one incentive, you ruled out of all the other ones. You can use all of them. And that's one thing we always make sure as brokers is that as a buyer, whatever benefits are available to you, that you're able to access as many of them as possible. Okay. One last little caveat on the must live in it as your principal place of residence. So after you build your first home or buy your first home, you've got to move in, you've got to maintain residency in there for 12 months. Otherwise, there's a chance you may need to pay back that $10,000. Okay. The next thing we have is stamp duty relief. So this is also a state government incentive. So it differs from state by state. Everyone's got their own threshold. So first off, stamp duty. What is it? All right. It is a fancy word for tax that we pay on an asset. Okay. So when we go to the supermarket, we pay GST, we pay goods and services tax. When we're buying a house, we're buying a car, we're paying stamp duty. So what we're talking about is the tax you have to pay when you buy your land. The great thing is, as a first home buyer, you can get by with paying no or very little stamp duty if you're looking at land and construction. Okay, so we can see here we get a full exemption, meaning you don't pay any stamp duty at all if your property is $600,000 or less. If it's more than 600,000 but less than 750, you'll still get a discount, but you don't get the whole thing wiped. So you'll basically get a discount on what a standard purchaser would get, but you're not getting the whole thing. Another important thing to clarify, this stamp duty and that threshold of 600, when we're talking about land and construction, we're only talking about land. So likewise, in the first home owners grant, builds less than 750, we get the first home owners grant. Stamp duty, if the land contract itself is less than 600, we're not paying any stamp duty. Okay, so what this means is, as a first home buyer, you could buy land for 600,000. You could do a build for 750,000. You're building a very expensive property, but you're still not paying any stamp duty. You're still getting the $10,000 first home owners grant. So very important to keep in mind that these thresholds for both the first home owners grant and the stamp duty only apply to one contract each. It's not got nothing to do with the total value of the property upon completion. Okay. Another important thing to remember, like with the first home owners grant, to get that stamp duty exemption, you have to live in it for 1 year after construction. If you don't, it's likely you'll have to pay that stamp duty back. So make sure to keep that in mind. So to clarify, we went over the first home guarantee scheme. That allows us to do a reduced deposit and get into the property easier. Then on a state level, we've got the first homeowners grant only for brand new builds or properties that haven't been lived in. And then we've also got our stamp duty exemption or concession. These are the three main things as a first home buyer that are going to save you money. Okay, so there's all that talk about these different things. What are they? What are they? That's it. It's those three things. And as I said, we'll make sure if you are eligible that you're taking advantage. So how do we go about applying for these things? How do we make sure we get it? Well, if you're working with a mortgage broker, or particularly, like myself at Mortgage Domayne, we'll actually handle all of that for you. We'll help you to complete the first homeowners grant. We'll lodge that for you through the bank. Likewise, with the first home guarantee scheme, we'll also help to complete that application form, send it to the lender, deal with anything that comes up on your behalf. Okay. The only thing that we don't particularly take part in is the stamp duty concession. That'll be handled by your conveyancer. Closer to settlement, they'll send you a form. It basically gets you to put in whether or not you've earned property, how much the property you're purchasing is, and then that basically gives an assessment to determine whether or not stamp duty is payable in your case. As I said, if we're a first home buyer, if we're a permanent resident or Australian citizen, and our land contract is less than 600, will not pay any stamp duty at all. Okay. So that's most of the first home buyer thing. So let's put a couple of things into context, all right, particularly about the 5% deposit scheme. And just one note on that, because we can see here on this slide, we've got 5%, 10%, 15%. So this 5% deposit scheme, it doesn't mean it just has to be 5. It's basically saying less than 20. So between 5 and less than 20%, that's when we use the guarantee scheme because it's going to save you money. How's it going to save you money? Well, let's have a look. So loan mortgage insurance. So lender's mortgage insurance, that's the fee that I spoke about earlier. When we want to borrow more than 80%, the bank's going to make us pay this fee. So we can capitalize it within the loan. However, even if we do that, it still works out the same. You're still paying for it. Okay, so if we look at a $950,000 purchase price, and this is the maximum under the home guarantee scheme, we can see a 5% deposit would have a deposit of 47,500. The loan would be 902,500. The mortgage insurance is between $45,000 and $55,000. That's a lot of money. And remember how we have to cover 5% deposit plus the fees? It's a very big fee when we add the mortgage insurance. We can see that the more money we put in, the closer we get to 80%, the less mortgage insurance we're going to pay. For example, if we put in 10%, 95 grand, we'd only be looking at 25 to 30,000. Likewise, if we put in a 15% deposit, we're looking at 12,000 to 15,000. So this can be very crucial in terms of getting you into that property sooner. Like think about how long it takes to save 45, 50,000, so if you're 45 to $55,000 closer to purchasing today, because you can use the guarantee scheme and you don't have to pay lender's mortgage insurance, it puts you so much closer to being able to purchase. And that's why it's a really exciting time for first home buyers with these new changes that have been implemented here. So look, we won't harp on about the lender's mortgage insurance too much, but I just wanted to give some examples of the different loan amounts, the different estimates and what that all looks like. An important note we can see here at the bottom, if we wanted to add that extra 50,000 of mortgage insurance into the loan, we'd need an extra $10,000 to $12,000 of income per year in order to actually afford the mortgage insurance on top of our loan. Okay, so once again, gets you in a whole lot sooner. All right. So moving on, I wanted to give a little bit of an example of how we can actually utilize all of these things together. As I said, it's not the case of using one and we can't use anything else. We can use all of them together. So let's go through a bit of an example today and have a look at what this will look like. So for example, if we're purchasing a house and land package worth 750,000, our 5% deposit that we're going to need to put in is about 37,500. That's how much we need to show that we've got saved in order to be eligible for the scheme. However, if we factor in that we've also got the first home owners grant of 10,000, although we're not having that as cash and we're putting it into the purchase, it's still money that we don't have to save and we don't have to borrow, so we can take that off of our deposit. So we can see here that our deposit's gone from 37.5 to 27.5. Following on from that, we've got no stamp duty because that land is less than 600. And as we've mentioned, using the first home guarantee scheme, no mortgage insurance either. So if we keep all of this in mind, fees for a first home buyer, you're probably looking at about $4,000 to $5,000, depending on who you are and what your eligibility is. If we can claim all of these things, very minimal. So if we look at our net deposit of 27.5, 4 or 5K more, that's all you're going to need to get in. So what we can see here is the fact that we don't have to pay stamp duty, which can be 20, 30, $40,000, depending on what we're spending. We can get a lot higher than that as well. And the fact that we don't have to pay that mortgage insurance, we're saving so much money on our upfront costs. Reduces the amount you need to save, reduces the amount you need to get an application underway, significantly shortens that timeline to getting you into your first home. So that really gives an example of what the different incentives are, how we can use them, how we can make sure to actually link that all up in terms of your overall purchase and taking into account all of those incentives together. But as I've alluded to, every case is different. Everyone's different. As a first home buyer, the two things you've got on your side is planning and time. They're scarce resources. The more of it you can use, the more you can take it to your advantage and make the most of those things, the better off you're going to be. So I will safely say that there are instances out there where you might approach the bank or you might approach a broker and they may say, you're not ready yet, come back and see me closer to the time. I'll say right up front, Mortgage Domain, we're really not doing that at all. We understand that as a first home buyer or any home buyer looking at land and construction, all you're after is information. You need to be as informed as you possibly can be in order to make this decision. So we're all about having that conversation. And when we have that conversation, it's all about determining, are we where we need to be right now to buy what we want to buy? And if we're not, what can we do to get you there? And obviously, the more time we have, the more time we have to plan and execute, the better off we're going to be, the more likely it is for you guys to be able to get into that first home. So, look, I think that just sort of wraps up the slides that I've got here. I think the next thing we might do is obviously jump into any questions. But just before we do that, obviously, in terms of how it all works, in terms of the process, next steps going forward, obviously more than happy to take anything offline, look into any further situations sooner. We've got a team of brokers available 7 days a week to help with any of those inquiries. We always just like to start with a quick phone call, have a chat, get to know what it's all about. Don't feel like we have to crack open that big can of worms and be sending all of our documents over, going to an application the next day. It's all about making sure that you have all of the information you need to make an informed decision for your first home. All right, so I think I'll park it about there. We might jump over into the Q&A. So if anyone's got any questions and wants to pop them through, feel free to do so. Happy to take as much time as we need up to 8 o'clock. And yeah, we'll take it from there. Alrighty. So one of the questions regarding the lender's benchmark via the HEM. So HEM, look, it's an interesting word. All it really means is household expenditure. Pardon me, household expenditure metric. It is a jumble of words, and all we're talking about there is basically the baseline level of expenses that are applicable to your household. So what does that mean, Mitch? Well, what it means is that depending on the amount of people that are in your house and how much money that you're earning within your household, the lender's going to have a baseline level of expenditure that they're going to attach to you. And they're going to say, this is the minimum amount of money you need to spend in order to meet your basic needs. So even if we're spending less money than that, the lender's still going to take that figure as a baseline. So the idea is we want to be as close to that mark as possible. Okay, so if the lender's got a benchmark of $5,000 for your household, but we're spending 8,000, that's where things like these borrowing capacity calculators might not quite be as accurate because how much money you're spending, how much is going out of your household each month, will really impact how much you can borrow. So when we talk about the lenders benchmarking via HEM, what we're talking about is comparing your expenses to that baseline figure and determining, are you below that? If you are, they're going to take that figure. If you're above it, they'll take it as per what your true expenses are. If you've got any other questions, wonderful. Alrighty, well, if that's about it, I think we might leave it there, guys. So, as I said, I'm more than happy to talk about any of the things that we've gone over tonight in further detail. As I've said, it's a lot to go through in a short amount of time. So, if there is anything that is needed, more than welcome to reach out to myself or the team at Mortgage Domain. We will be sharing our details with you, but otherwise, you're more than welcome to head over to our website, mortgagedomain.com.au, and you can leave us an inquiry there. Thank you very much, guys. Really appreciate your time. Take care.